Hi, folks. How are we doing? Good. Yeah. So, some stuff to talk about. So, as far as updating assignments moving forward goes, I have some good news and I have some bad news. So let's do the bad news first. Let me get the bad news out of the way. So I've been trying to update the idea assignments, and as you all may or may not know, the Truman State Computer Network has just basically been fighting the past few days. I spent an hour and a half trying to log on to the virtual client and get on the desk or get on one of the 10 zigs. Was not able to do it. And unfortunately, IDEA is not installed in 1420, which I probably should have, but my thought is that if we need it in 1420, then you can always access it versus via the virtual desktop, which my bad. So what does that mean? It means our first homework assignment actually has an IDEA component to it, which again, it's optional. You don't have to complete it, but it's really easy. So it's just like easy 5 points. If we're still having trouble accessing the computer system, like the 10 zigs and IDEA, and you don't want to up or download IDEA onto your own computer, I get that. I'll probably extend the due date for that assignment just for that. I'm not going to make it one of those things that everybody cannot do the assignment simply because the computer network is down. I'm hoping for better results over the next couple of days. Like I said, it's a very easy assignment, but it does require actually opening IDEA. Barely opening IDEA, but it does require that. On the good news, I expected my GTRA to take a few weeks to update the Excel assignment. He finished it in like a couple of hours. So we have an example for the Excel assignment posted on Brightspace. It's not 100% complete. I still need to check and make sure that all the companies are present in Morningstar. Basically, I created this assignment like 7 years ago, and ever since then, companies change. They collect or they merge, they downsize, whatever, they rebrand. And so I have not checked all of the companies to make sure they're Morningstar, but everybody has been assigned to a company and the instructions are up to date, aside from the fact that I need to make sure the companies are correct. So if you want to start taking a look at that, it's great. It's not due until beginning of November. We do have some time. I think that's like week 11 or week 12. So it is a ways away, but it's also one of those things that I encourage you to look at sooner rather than later. You probably won't be able to do too much with it right now other than just kind of some formatting stuff because we haven't talked about how to do an analytical procedure, but never too late, never too soon to start. I think that's it. So I apologize today. Apparently some exciting stuff's happening on the quad with Sister Cindy. I'm not going to be nearly as entertaining today with that. I actually really like this lecture. It's my favorite lecture, but it's not going to be entertaining. On the plus side, I won't ask you nearly as many personal questions. So yeah. So yeah. Well, let's see. I cracked myself up when I was in. It wasn't. I said something really weird in AIS, and I started laughing. I couldn't stop laughing. I'm going to try to avoid doing that today because we don't have that kind of time. Time's a precious resource. So we got a lot to talk about today. So we're starting out with chapters 1 and 2, Introduction to Auditing. And this is where I get to teach everybody about the wonderful world of audit and what I fell in love with. So let's start out with some semi-rhetorical questions. I do want some feedback on this and try to be honest on this. What is your goal in this course? So you're going to say, well, Dr. Barnes, I want to be the best auditor I ever can. I said, but you grew up in Pokemon. I want to be the very best like no one ever was. Is that the way to? No, you're not. Your goal is not to be the best auditor you can. What's your goal? To be honest, come on. You want to get an A in the class. You want to get a good grade in the class. Okay. What is my goal in this course? Your goal is to give me an A, Dr. Barnes. Yeah. Well, we got to problem solve. We don't have to do any work moving forward. No, my goal is to teach you about auditing. Make sure that you're competent by the time you leave this course, that you know about the concepts of auditing. Can we agree to that? Those are effective statements. Okay. Now, if you want to learn about auditing as an ancillary effect, that's fine. But your primary goal, you want to get a good grade. You want to get a reasonable grade and pass the class with flying colors. All right, let's switch gears then. After graduation, what's your goal? Job. Is that really your goal? Is your goal really to get a job? If I were to say I'm gonna pay you $10,000 a month to sit at home and watch Netflix, would you jump on that opportunity? So is your goal really to get a job? Make a living, yeah, to earn money. Okay. What is your potential employer's goal? Yeah, find people to know what they're doing that I can actually provide value to the organization. Okay. So we'll notice here that these are related questions, but they're not the same question. Can everybody agree to that? These are not the same question and they don't have the same answer. So We're going to talk a little bit about why that's a problem. So let's start out with just some theory. You probably heard this concept, principal agent theory, in your finance class. But in organization, or specifically a corporation, we'll talk about corporation, corporate form. Who are the principals in a corporation? For those of you who've done finance. So the principals, those are the owners, okay? When you hear the term principal, those are the owners of the organization. Who are the agents? Managers, okay? The managers are the agents, run the organization on behalf of the owners, of the principals, okay? So that's actually a good thing. That's why corporate reform exists, is that you can be an absentee owner, which, that's whether or not how you feel about corporate reform, you can actually invest in something and you can earn money without actually having to be an active participant in it, at least not a day-to-day active participant. Which again, I'm not trying to judge what your thoughts are on corporate form, but that's just kind of what are traditionally in the United States we see for large organizations, is they tend to operate via corporate form, whether privately or publicly, they tend to all operate according to that paradigm. So the good news is we have a body of individuals who can run the organization on behalf of another group of individuals. The problem is the people who own the organization do not see everything that's going on a daily basis. The people who are running the organization, they do. And so they have different levels of information. As we call that, that's called information asymmetry. Means that two groups within the organization, that principals and agents have differing levels of information about that. So, and similarly, when we talk about the nature of the organization, there's a conflict of interest. So if you're the owner of an organization, you're generally concerned about long-term benefit, long-term wealth of the organization. You want to see your investment last forever. It's the Warren Buffett philosophy. He wants to invest in a company and make it increase in value over perpetual, or for infinity, basically. And is that necessarily what the executives in an organization want? Do they want to see the organization thrive for infinity? Most of the executives have a much shorter term window, because if they don't perform in a certain window, then they lose their job. If you don't do well in the current year, then we're going to replace you. So their goal is short term income. Now that's a conflict of interest, because those executives may not necessarily make the best decisions in the short term that would benefit the organization in the long run. All right. Who is going to win out in that scenario? Is it going to be the owners, or going to be the agents? Well, keep in mind, the agents have more information about the way the organization is run. So if they want to do something that benefits them, they're in an advantageous position to do so. They can say, all right, or the owners basically say, hey, we want you to do what's in our best interest. And say, yeah, we're doing that. And then they could totally not do that. They could lie. I don't know if you've ever heard, have any managers of large organizations ever lied in the past? Never happened, okay? It's never happened because auditors are so good at their job. No, it happens all the time, okay? So we do have a check against this, something you learned about in 220. We've got financial statements. What is the purpose of financial statements? It's so that we can actually provide transparency as to the operations of the organization. The managers prepare financial statements and provide them to the stakeholders, primarily owners, and say, here's how the organization performed in the last year. I hope you're happy with the performance. And if the owners are, then everything's good. If the owners aren't, then usually some bad thing, some upheaval occurs, okay? Now, here's the problem. We know there's information asymmetry. We know that the managers are the ones who prepare the financial statements. Is it possible that the managers could create phony information in the financial statements? Could they lie in the financial statements? Has that ever happened? Once or twice. Once or twice it's happened, okay? So yeah, there's one of my favorite books to read is called Bad Blood. It's not the Taylor Swift song. It's actually about the Theranos organization, and they provided very, very bad picture of their earnings to their shareholders, and they basically provided no full transparency. So if that's the case, what is the solution to this problem? What is the solution to this problem? It's to have somebody come in and make sure the financial statement information is correct. Who are those individuals? Those are the auditors. Okay, or the organization is the auditor. They're the ones who come in. All right. Way to simplify this is to basically say the auditor acts as a mediating role between the principal and the agent. And we'll take a look at a diagram that's associated with that. So before we look at that diagram, though, I want to ask you some interesting questions. So we know that your goal in this course is not the same as my goal. Okay. My goal, teach you auditing, your goal, get an A. All right. Is there a way I can align those goals? Can I achieve goal congruence and say, I will give you what's your objective if you achieve my objective? So yeah, I can do that. And what is the mechanism that I use to accomplish that? So you can say the coursework, but for probably the most critical point of your grade is going to be what in this course? Exams, yeah. So exams, okay. So, oops, exam. That's the front page of my exam, traditional exam. All right. Same thing, same question. You want to make a lot of money. Your employer wants to hire somebody who's skilled and provide value. Is there a way we can make those goals congruent? Hire people who can actually do the job and pay them a lot of money. How are they going to know how are they going to test that they're hiring the best people, the people that they want to give that money to? What's a document that you usually have to provide to your employer? Yeah, resume. Good. Okay. That's not really a resume. It's my Vita, but a CV, but it's the closest thing I have to a resume data. So when you become an academic, they don't call it a resume. They got curriculum vitae. That's what they would call it. Yeah. Anyway, so yeah, and auditors do the same thing. Auditors effectively act in the same role. They provide a report on the performance of the organization, usually on an annual basis. All right. Now, don't read this document and say, okay, I need to memorize this document of the report. This is a really old version of a report. Okay. We'll actually look at new versions of reports much later in the course, but this is kind of the same idea, is that we're providing some sort of alignment between the principal and the agent, okay, between the two parties. So this is kind of the relationship here. This is a little bit more dynamic version of the relationship. We know that principals and agents have a relationship and information asymmetry exists. The auditor comes in and basically says, hey, the agents are doing a good job. The principal can be satisfied with what's being reported as accurate. Or in some situations, the auditor can come in and say, yeah, they didn't do a good job at all. You should be aware. Okay. Whatever the situation may be, the auditor's role there is to actually make sure that the representations made by the management are correct. All right. And that is basically what we're going to be learning over the course of the semester. How do we accomplish that? What are we going to be doing to make sure all that's correct? It seems really straightforward. It seems like it should be a snap judgment right there and the auditor gets the job done. But if you ever heard those horror stories about auditors working long hours, there's a lot of things to look at, because we know that financial accounting information can be very broad and a wide array of detail. So how are we going about doing that? We're going to have a lot of different mechanisms for evaluation. So let's start with one of the most important things. I think probably the most important thing with respect to auditing. I think a lot of people understate this, but I personally think that if you understand this next concept, your auditing is good. It's like Mr. Miyagi and Karate Kids. Like if your balance is good, your karate is good. Okay. If your understanding of the next concept is good, your auditing is good. I'm the Mr. Miyagi of this classroom. Okay. So in the examination example, what assertion are you making regarding this course? So if so with acceptance, I remember the examination is how I'm testing your knowledge of this course. What assertion do you make? You're going to make the assertion, Dr. Barnes, I understand what you taught me. I know what you taught me. I feel confident that I know what you taught me. Okay. And then I'm going to test that assertion by giving you an exam. I'm actually going to give you an examination and say, okay, show me. Because if you legitimately know what I was talking about, if you understand it, you should be able to replicate that activity on an examination. That's true for all your classes. Is that correct? Or most of your classes. All right. In the resume example, what assertions are you making regarding your qualifications of the job? That you're qualified to do the job and you will do an effective job there. So how do the prospective employers test those assertions? There's multiple ways, but again, they evaluate your resume and they say, compared to other individuals, this person looks like they'd be good fit. Okay. Or they see the words Truman State University, they're like hired, one of the two. It works out. You guys think I'm being facetious about that. Some of the public accounting firms, they see Truman State University, they will fight over you guys. They will fight. Okay. They have a high opinion of those because of previous Truman State graduates. So you made a good decision because we got a long line of good graduates. And I'm not even saying because some of them might watch my video at some point. I don't think they will. They probably don't want to watch that. But anyway, like I'm saying, yeah, you're trying to actually make the representation that you're going to be doing. You would do a good job. So that the key word there is something I use a term there. It's called assertions. Okay. You'll notice at the top of the slide, the title says management assertions. This is a critical thought or critical piece of information for this particular course, management assertions. When we look at financial statements, the information that's contained within the financial statements contain underlying assertions made by management with respect to that. Now, I'm going to give you a list of these assertions. You can write them down or not. We are going to go through these in exhaustive detail in chapter 5, but I want you to review them because this is going to be how we frame the entire course moving forward. Okay. So these are called management assertions. I sometimes refer to them as audit assertions. You may just hear me say assertions. For this course, when you hear the word assertion, this should be your thought. Is one of these 8 items. So we've got the big three, which are completeness, existence, occurrence, and valuation, allocation, and accuracy. I will say 70 to 80% of the examples we'll look at in this course will relate to one of these three assertions, okay? Then we have rights and obligations. Then we have some specialized assertions. We have presentation and disclosure, which you'll notice I've got in brackets next to that PCAOB. This assertion is officially only recognized by the Public Company Accounting Oversight Board, which we'll talk a little bit about what that organization is here in just a bit. Then we have classification and cutoff. These two assertions are not recognized by the PCAOB. They're recognized by the Auditing Standards Board, which the Auditing Standards Board is a subset of the AICPA. Is anybody familiar with the AICPA? American Institute of Certified Public Accountants. Okay, we'll talk a little bit about their role as well. And then I want to throw this in one here because no matter what, even in the new edition, we can't get rid of this one. We have authorization. And MGP stands for the authors, Messier, Glover, and Prods. This book is a great book, but it's been around forever. And so editing certain stuff out that's no longer relevant is a real challenge. They even admit in the textbook this is no longer an actual management assertion, but they still won't get rid of it. Even in the newest edition, they won't get rid of it. So the only reason I put it up there is this might come up as a question in homework or might come up as something in your reading. This is not a relevant assertion anymore. It's no longer recognized by any of the standard setting bodies, but you know, the authors of the book just don't want to let it go. You know, it's I don't know. I don't have a good analogy for that one, but I criticize just for that. I keep hoping that it's going to go away. So when we think about assertions, these are basically underlying premises for the information in the financial statements. Now I'm going to give you a simple example, but we'll expand upon these examples pretty thoroughly later on in the course. All right. So you look at a line item in the financial statements for, we'll say, inventory. What does that inventory line item represent? Okay, it says inventory is $1 million. All right, so we can say that the management is representing, they're making an assertion that inventory exists, that we could actually physically look at the inventory and see that inventory in place, and that it's properly valued. So two of the assertions related to that inventory would be existence, occurrence, and valuation, allocation, accuracy. Does everybody understand kind of the premise for that? Now, when we talk about the nature of the assertions, it'll be much easier to analyze how they represent, but they do align pretty closely to what the words say, okay? Some of the words are a little bit hard to follow, and I'll give you some tips on how to approach those. But inventory is a very easy example. It's a tangible asset. So we can say, well, if I look at the tangible nature of that asset, I'm pretty happy that I know it exists. And if I look at the cost basis, I can calculate what it should be valued at. So it's a very easy way to look at it. Another thing we need to note is that when we talk about these management assertions, they can be at one of two levels, and we're going to be very concerned about which level they operate at. Okay, so there's two levels of concern. Technically three, but the third one is considered to be operating at both levels. Okay, the first level is at the transaction and event level. So that means day-to-day operations of the organization. So my inventory is being valued for every single transaction properly. Okay, my inventory actually exists for every transaction that I engage in. All right. The second one is going to be at the account balance level. This is more the aggregate financial information level. So the information that's on the financial statements is accurate. Now I mentioned there's a third one. The third one is the disclosure level. But for disclosures, we're concerned about that at both transactions and events and account balances. So we're going to basically ignore it. I'm not going to make the representation, but I want you to think about this when I say this. When I say account balances, I'm saying all the disclosures are consistent with the account balances. When I say transaction events, all the disclosures are consistent with transaction events. Excuse me. On the next slide, it actually shows what assertions are relevant to what area of assertions or for what category of assertions. And you will notice that there's a big overlap. Many of the assertions appear in both sets of categories, in both categories. But the interpretation of how they apply is different depending on the category. So when I say something like completeness means something different at the transactions and events level than when I think about it at the account balance level. And again, you're very curious, and I know that you're like, okay, well, what's the difference, Dr. Barnes? I said, well, I haven't taught you what completeness means yet, so explaining the difference is probably not relevant. I promise we're going to get to that, but I don't want to hit you with information overload right now. We're not trying to learn everything in a day, though I really respect the search for knowledge right now. All right, so we've got these management assertions. These assertions represent information that's in the financial statements and the operations organization. Our goal as the auditors is to make sure that those management assertions are accurately represented. Okay, so we're going to go through doing that in a number of ways. The very first thing we need to talk about is we need to talk about how does the audit engagement align with what the financial accountants present. So you're probably familiar with this information over here on the side, okay? Basically, management creates internal controls, conducts transactions, and prepares financial statements and issues them, okay? We know that that's a pretty straightforward routine for financial accounting. As auditors, we need to actually create an engagement with the client, which are going to be what we talk about in chapter 3. Then we're going to obtain evidence about these first 3 areas, about internal controls, conducting transactions, and accumulating transactions into balances. We're going to gain evidence, and then we're going to test the assertions that are in the financial statements. Once we've done that, we will communicate to stakeholders whether we think that information is accurately represented or not. So our testing is going to be very closely aligned to the work that the financial statement accountants do. Now, it's not to say that we'll do it simultaneously. We're trying to actually get to that point, but currently, most of the work that's done in an audit is after the fact. So transactions take place over a year, account balances aggregate over a year. We come in a year end and say yes or no, okay? And so usually it takes place subsequent to all of those transactions. So what are some things that we're concerned about with respect to management assertions? Or how do we categorize management assertions? I shouldn't say categorize. How do we think about management assertions? Well, there are 3 fundamental accounting concepts that are going to closely relate to the beginning of this course, all right? So the first of these 3 concepts, these 3 fundamental concepts, is something called materiality, okay? Now, I'm not going to define it too much in detail right now because I've got slides that explain all 3 of these concepts here in just a second. But the first of these is called materiality. The second of these is called audit risk. What I do want to talk about is I want to talk about that these 2 right here are probably the most critical, as these affect the nature, extent, and timing of audit evidence that we have to gather. All right. Now, what does that mean? All right. The reason I say nature, extent, and timing, by the way, that's actually something that's used in Becker. They talk about the net of evidence. You have to throw out a net. And if the net needs to be bigger to gather more evidence, that's kind of the idea behind that. You have to actually increase the extent of the work that you're doing. You have to change the nature of the work to gather more evidence. So change the net, okay? Change the nature, extent, and timing of evidence to be gathered. It really depends on how risky the assertion that it is you're trying to test. So let's test 2 hypothetical assertions, okay? Let's go ahead and say I make the assertion that I am an accountant. Me, Michael Barnes, I'm an accountant. Does everybody feel comfortable that they could test that pretty easily? Okay, what would be the very first thing you'd do? You'd go online to the Truman faculty site and say, oh, he's a PhD with a PhD in accounting. He's also got his CPA, and he's been teaching accounting at Truman State for 10 years. I feel pretty comfortable with the assertion that he is an accountant, okay? The amount of evidence you have to gather to test that assertion seems to be really small and very easy to gather, okay? Not particularly difficult. I'm going to change the scenario now, all right? I'm Michael Barnes. I'm a vigilante superhero. Does everybody feel comfortable that they could test that assertion or not? It's like Batman. Nobody knows his identity. I could be Batman. You never know. Okay. How much evidence would you have to gather for that? Probably substantially more than you have to gather for accounting. Now, I am not a vigilante superhero. Okay. But a vigilante superhero probably would tell you that they're not a vigilante superhero. So I'm going to keep you guessing. Okay. Now, that's what we mean by nature, extent, and timing. We have to actually increase that as long as it becomes more difficult to test the work. And we'll talk about when we make that determination over the course of the semester. The third fundamental concept is audit evidence. And this is evidence that relates to management's financial statement assertions. So we gather evidence related to those assertions made by management. So let's go ahead and talk about each of these 3 in detail, because these 3 are really important. And we're going to get a much more exposure to this because these actually relate to the chapters that we're going to be doing after this. Materiality will be the second part of chapter 3. Audit risk will be the majority of chapter 4. And then audit evidence is going to be the majority of chapter 5. But let's talk about materiality, one of my favorite things to talk about. So your favorite band, the Caden Brothers, not to be confused with the Jonas Brothers, playing 2 dates in Kirksville, okay? You've made the decision to skip auditing class because apparently the Caden Brothers manager schedules during auditing class. You know, who would do that? A tax professor. That's who would do that. Okay. You have 2 possible choices: missing a day that will be working on an in-class assignment for 5 points, or missing a day that will be taking an exam, 100 points. All right. Which one do you choose? Choose A1 because you're missing out on a much lower level of points. Okay. So yeah, that's a pretty relevant decision. You made that decision pretty snap because you looked at the number of points relative to one another and say one is worth a whole lot less. Okay. Let me preface that by saying that you probably know that the number of points in this class is around 500 points. Okay. So 5 is 1%, whereas 100 is 20%. So that's a relevant concern. What if there's 1,000,000 points in this class? Does that change your consideration here? Yeah, you're kind of like, I'm gonna miss both classes. I'm just gonna watch two Game Brothers, okay? Yeah. Yeah. You're just kind of like, if it's such a large amount of number, those smaller numbers aren't relevant. And that's materiality in a nutshell, is the idea that it would affect the decisions of a reasonable user of that information. Okay. So the higher total points, the higher the level of materiality that we'd have to actually associate. Those large small numbers don't really matter anymore if it's a really large number. Specifically, when we talk about materiality, the FASB has provided the following definition. Information is material if omitting it or misstating it could influence the decisions that users make on the basis of financial information of a specific reporting entity. And it's very, very consistent with the idea that it depends on the size of the reporting entity. So I'm going to tell you, I perform an audit, and the client, my audit client has a misstatement of $1 million. Is that material or not? What do you think? What's always the correct answer in any accounting class? It depends. That's right. You guys remembered it. Good job. Okay. What does it depend on? It depends on the size of the client. If my client is Greek Corner Euros down the street, is $1 million likely a material amount? Probably very material. I doubt they earn that much in a year. Okay. If my client is Walmart, is that a material amount? They're probably like $1 million. We eat that for breakfast. And it's probably a literal statement. Yeah. So it really depends on the size of the organization. So if the misstatement would change the decisions of a reasonable user, $1 million isn't going to change Walmart's decision makings or their stakeholders' decision making. Okay. So we have to consider that. Now, it's important to note this is a really, really challenging criteria to meet, simply because reasonable user is a very subjective statement. And we're going to see that a lot in this course. We're going to see subjectivity at its premium. So like, all right, what is the correct amount of materiality? It says there is no correct amount. There's only what we assume is a reasonable amount for materiality. But we'll talk about how to get into that in a little bit. All right, let's talk about audit risk. So the auditor standard report states the auditor provides reasonable assurance that the financial statements do not contain material misstatements. So the phrase reasonable assurance implies that even when the auditor does a good job, there's some risk that a material misstatement could be present in the financial statements. The auditor will fail to detect it. Now, why do we use reasonable assurance? Why don't we say absolute assurance? That's a much stronger statement, right? So why do we actually default to reasonable assurance? There must be some reason. So if I say, how are you going to do in the exams? I have reasonable assurance I will do well, Dr. Barnes. Okay. Okay. I say, well, why don't you provide me with absolute assurance? What is that going to do to your mentality? You're gonna be like, oh my gosh, how many hours do I have to study? I have to study every hour between now and the exam. Basically, absolute assurance is impossible. We do not have the resources, we do not have the time, nor the money, nor the personnel to achieve absolute assurance. I mean, we're getting closer to it, thanks AI, but we don't have absolute assurance. So we default to reasonable assurance, which means that by nature of this, it's possible we could do a good job and still not achieve our goal. It's possible, I sincerely hope that this doesn't happen to anybody, but it's possible you all could study an adequate amount and cover the correct material for the coming exam and still not do well. I'm not trying to jinx you, by the way, okay? I'm just trying to let you onto that possibility, okay? It's not likely to happen, but it is a possibility. This is the concept of audit risk. The auditor mistakenly expresses a clean opinion when the financial statements are materially misstated. Basically, what that means is they do their job properly, yet they missed it because of the nature of the testing they performed. Like if they tested a different area, they would have caught a massive fraud, but they didn't test that area, and it was an honest mistake. Audit risk doesn't apply anything nefarious. It just means that because we can't test everything, we're not omnipresent, that there's a possibility we can miss something. Usually that possibility is very remote, very small, but it is a possibility. All right, the third concept that we talked about is evidence, all right? And just like the assertions, I'm gonna give you a long list of terms. You don't need to write those all down now, but these are kind of the idea of what we're gonna be looking at for testing. So these are all types of evidence that we can gather over the audit process. Now, some of these, or one of these should be pretty obvious, okay? You see inspection of records and documents. If I say, what evidence would you collect? Even if you know nothing about auditing, you'd probably say accounting records, Dr. Barnes. I'd say you're very clever. That's correct. That is our default. looking at records and documents. Those are the accounting records that we all know and love because we've helped prepare those before. But there's a lot of other things that we can collect, okay? We can actually go look at physical assets. We can observe people doing their job. We can talk to people who do their job. We can actually send requests to people outside of the organization. That's called a confirmation. We've got all these things that we can do with respect to testing this information, and it all provides us with additional assurance regarding whether the information is correct or not. So that's the nature of audit evidence. This is a big part of chapter 5, by the way, but trust me when I say that we will have so much exposure to this that you should feel very comfortable. And it will set the frame for how we actually test everything moving forward. All right. With respect to the audit process and objectives, the end product of an auditor's work is an opinion indicating whether or not the client's financial statements are free of material misstatement. Now, you will notice that I use that term a couple of times now, and we want to make sure that we understand, because I use that term materiality. We said materiality is the something that would affect the decisions of a reasonable user. So by logic, material misstatement is something that is large enough to affect, it's a misstatement that's large enough to affect our decisions. We say a material misstatement is basically something that's enough that an auditor is going to say everything is fine, moving from that to everything is not fine, okay? So that term material misstatement is going to be something we'll see quite a bit of. And it's kind of that idea of materiality with the term misstatement combined together, saying, what is it that is going to change an auditor's opinion from things being okay to not okay? So there are 4 types of opinions that an auditor can issue. Now, the first one is really straightforward, okay? This is that there is no material misstatement, okay? It's called an unqualified opinion, an unqualified opinion. Now, I need you to write some stuff down because this is not stuff that's in the slides, but you're going to encounter this, okay? I want you to write down the next unqualified. I want you to write PCAOB, all right? We'll talk about what PCAOB is here in just a second. Once you've written down unqualified PCAOB, I want you to write down below this unmodified. Unmodified, and I want you to write next to that ASB. Now, what that means is that there are 2 different terms for the same type of report. This is an opinion expressing that the financial statements are free from material misstatement. If it's a public company audit, which is the PCAOB, it's called an unqualified opinion. If it's a private or a non-issuer audit, which is under the purview of the Accounting Standard or Auditing Standards Board, ASB, it's called an unmodified opinion. The reason why is you will see both of these terms used in the book. They mean exactly the same thing. It means a clean opinion. Everything is good. If you see unqualified, you should say, great, everything's good. If you see unmodified, it should be great, everything is good. Now you're probably asking, oh, are we gonna have to learn 2 terms for every report? The answer is no. This is the only time that an opinion changes the terminology. Okay, I don't know why the ASB changed back when the Sarbanes-Oxley Act was in place, and they just kind of like said, we're gonna use a different term, and then stuck their tongue out at everyone. So they're just trying to be divisive for a purpose of being divisive. But they mean the same thing. Everything is fine, nothing is ruined. All right. So if that's the first opinion, the rest of the opinions must be there's a problem. Second opinion is called a qualified opinion. Now, this is the same term for both organizations, by the way. This is both true for public and private organization. It's qualified in every situation. There's no such thing as a modified audit report, at least not from an opinion perspective. This is the same term we're going to use in both organizations. And this basically means everything is fine except for something. 2 words you will always look for in a qualified opinion, except for. 2 words you will always look for in a qualified opinion, except for. So what we're saying is that there is material misstatement, but we don't think it's big enough for us to say it's a disaster. Basically, the way that the PCAOB and the ASB define it is it's material, but not pervasive. So material is big, pervasive is very, very big, okay? Material, but not pervasive. A qualified opinion can occur in one of 2 scenarios. That there's a material departure from GAAP, okay? Everybody know what GAAP is, generally accepted accounting principles. So say, for example, our client is supposed to be using FIFO, first in, first out. Instead, they're using cost of market method for inventory. Is cost of market a valid method for inventory under GAAP, by the way? It is not. It is not, okay? So we would report that. We would say a qualified opinion saying their method for valuing inventory results in a misstatement of X dollars, which we think is material. Except for that one item, Everything else is correctly stated. Okay, so that's the first one, a material departure from GAAP. The second one is a material scope limitation. Scope, S-C-O-P-E, limitation. When we use the word scope limitation, we're talking about the work that the auditor does. The scope of their work represents the body of the work that they're doing on an engagement. So this is the scope of everything that we looked at. If some of that is chopped off, if I'm not able to look at something, my scope is limited, okay? Can you get as clear a picture when your scope is limited? Like, think about if you're driving in the car, okay? You're driving the car and you've got your view like that, and you've got your rear view mirror. Suddenly somebody rips out your rear view mirror. Are you going to be as effective a driver in that situation? No, your scope has been limited, all right? If it's a material scope limitation, we're going to say, except for whatever this issue was, everything's fine. But we were not able to do our job in this one area. We had a scope limitation. We were not able to look at inventory. We're not able to look at accounts receivable. We're not able to look at cash. This restricted our ability to make a judgment in this area. That's what a scope limitation represents. So material departure from GAAP, material scope limitation. Then we have the extreme audit opinions. We have adverse. Adverse means the financial statements are materially misstated. Financial statements are materially misstated. Or in other words, there is a pervasive departure from generally accepted accounting principles. Remember earlier I said for qualified opinion, I said if it's a material departure from GAAP, we can say except for this one thing, everything is fairly stated. Now I'm saying this is so large that we can no longer say the financial statements are fairly stated. They have a material misstatement in them. This is where a situation where we say things are bad. This is one of the two bad, really, really bad opinions that we can issue as auditors. Clients do not like to have this opinion because basically that means that people who look at their financial statements say, oh, we're in trouble. Okay. So the first one, financial statements are not free from material misstatement. They're materially misstated. Pervasive departure from GAAP. The other type of audit opinion is called a disclaimer of opinion. Okay. A disclaimer of opinion. Now, there's actually two scenarios that you can have a disclaimer of opinion. The one that I want you to know and I want you to harp on is a pervasive scope limitation. A pervasive scope limitation. Our scope was so restricted that we should have never gotten in the car to drive in the first place. Somebody put a blindfold on us. We had no view whatsoever. We tried to move and we was like, nah, I'm not doing this, okay? Scope limitation was so severe we could not do our job. We couldn't look at any of the major accounts. We were restricted from doing any of our testing, whatever it is, we could not do our job. Thus, we do not issue an opinion. Disclaimer opinion basically means that we do not issue an opinion. That's what disclaimer opinion means. Now, the other possibility, and this will come up, we'll see it one time, but you don't need to worry about it as much for right now. There's a possibility under private company audit rules, so ASB rules, if there's a lack of independence between the auditor and the client. Okay. I'm going to pick on Tommy because I know his relative is. Tommy audits his cousin, which actually I don't think that's a close enough relationship, but we'll assume that it is. So Tommy audits his cousin and issues an unqualified opinion, but he can't actually issue an unqualified opinion because he's not independent from his cousin. So he's got to issue a disclaimer opinion because even though he did the audit, he is not independent from the client. Okay. Should have picked on Anna. I should have had you audit one of your sisters. That would have been better. Yeah. Either one's fine. Either one's fine. All right. So lack of independence. Generally speaking, public company audits, that's never an issue because you can't audit if you're not independent. This only comes up in private company audits and only occasionally. All right. So moving forward, we've got some chapters that we're going to be talking through, and we're going to start our chapters on next week or next Friday, this coming Friday. And I should say it is technically next Friday, but I don't mean next week Friday. I mean 2 days from today. We're going to talk about client acceptance, continuance, and preliminary engagement activities. And we're going to start with audit planning. We're going to wrap up with materiality. Also, there's a discussion on Monday where we're going to talk about client continuance. So you need to be prepared to discuss the first discussion on Monday. Then we're going to be going to chapters 4 and 5 for how we're going to plan the audit and how we actually do the testing, which this seems to be like a subset of planning the audit, but this is a lot of detail and a lot of information. After the first exam, we're going to talk about internal controls. We're also going to talk about how we do sampling, which is chapters 8 and 9. We're going to skip chapters 10 through 16 and wait those to the end, but we're going to do completing the audit and then issuing the audit report as part of the second exam. And then we're going to mass this into a 3-week blitz for the end where we do business processes. I'm not going to spend too much time on this slide, but I do want to note that if you've ever encountered in public accounting the term auditing, they usually don't say audit practice. They use something called the assurance department or assurance practice. Has anybody seen that before? Basically, auditing is part of a larger body of work that we call assurance or attestation, and they're very closely related. Auditing is a very specific set of rules and a very specific set of procedures. Assurance and attestation are far more broad, but they represent similar philosophies, is that we're trying to improve information on behalf of the people who are trying to access that information. So a very close relationship, but auditing means something very, very specific. We're going to talk about assurance and attestation close to the end of the second exam review. So right before the second exam, we're going to go to chapter 21 and talk about the nature of attestation and assurance. All right, so we got some time. Let's talk about philosophy. What do you guys say? Everybody ready for philosophy? So is it possible to do well on an exam without knowing the material covered on the exam? What do you guys think? I wouldn't encourage it, but it is possible. It's possible. You may get lucky. You may just say, I'm going to circle A for every answers, and that's the day I feel whimsical, and I do A for every single one, you know? All right. Are there reasons why the most competent and qualified candidates for a job might not get hired? Nepotism, that's it right there. Is it possible people could lie on their resume? Also, is it possible up here people could cheat? That's a possibility as well, okay? Let's just let's chop the Gordian knot. Do the ends justify the means? What do you think? We're going to get down to utilitarianism versus teleology here. Or actually, utilitarianism is teleology. I meant deontology. The universal maxim. Okay, ends justify the means? Well, the answer from an accounting perspective is no longer yes, okay? It used to be, back before 2002, they said the ends justify the means. Now they say the ends do not justify the means. So what do we mean by that? Well, prior to 2002, audits focused almost exclusively on whether the financial statements are free from material misstatement. And internal controls was optional and afterthought, okay? Now, are internal controls important? You guys all took AIOS with me. I talked all about internal controls. So is they important? Say, I don't remember anything you said, Dr. Barnes, so obviously not, okay? It's been a summer, I get that, okay? So let's go ahead and think about this. Let's think about this. Does everybody know my favorite restaurant? Does anybody remember my favorite restaurant from talking last AIOS? Seabreeze, yeah, Seabreeze, yeah, Seabreeze. And so I'm going to use an example. Now, I want to say this is completely hypothetical and it's never happened, okay? But I love the cheeseburgers at Seabreeze. In fact, I did not get to have a cheeseburger the weekend before because they were closed down. And so I'm going tomorrow and I'm going to be like there. They open at 5 o'clock. I'm going to be there like 4:59 in 30 seconds, okay? But let's say I go and sit down for my cheeseburger and I'm just really, really excited about cheeseburger. I can't wait to eat it. And I see them preparing my cheeseburger and I know it's going to be delicious because it always is. But the person preparing my cheeseburger all of a sudden sneezes on my cheeseburger. No longer a cheeseburger, it's now a sneeze burger. I can't take credit for that. One of my students today said that. All right. Is the cheeseburger probably still delicious? Am I going to consume that cheeseburger? Okay, can we say that the process of creating the cheeseburger didn't matter in my assumption there? The end result doesn't matter. I'm not going to eat that cheeseburger. I don't care what the end result is. I'm not eating a sneeze burger. All right. So we do know that the process is important, and that's what the Sarbanes-Oxley Act started to imply, is that, look, internal controls can't be an afterthought. We have to understand the process by which financial statement information is generated. So now auditors have a responsibility not only to test internal controls, but to provide an opinion on them. This is true for public company audits, by the way. It's no longer required. It's still not required for private audits, but it's highly encouraged. So when we start talking about internal controls in this context, is because we now have a 20-year tradition of saying we can no longer just look at the end result of what the numbers in the financial statements are. We also have to look at how those numbers were generated, because the process does matter. All right, some parting thoughts here. Okay, so some types of auditors. We're going to focus on external auditors for this course. We're going to focus heavily. These are people from outside the organization who come in and test within the organization. I don't want you to confuse this with the concept of internal auditors, because you probably have heard this term before, but these are people who actually work for the organization and try to improve the quality of information for that organization. We're also going to talk briefly about governmental auditors, and while not a focus of this course, you probably hear me refer to forensic auditors. First of all, because forensics has become a burgeoning area of accounting work. A lot of organizations have departments there. Secondly, I'm a former forensic auditor, so what has 2 thumbs in a forensic auditor? This guy, yeah. So corny. All right, yeah. Some other audit services. We have internal control audits, which are required for public company audits traded under SOX 04, compliance audits, operational audits, and forensic audits. We can also engage in other types of attestation and assurance services, though some non-audit services The problem is that especially for public companies, most non-audit services are now prohibited by the SEC, which makes sense because a lot of organizations, they would make bad decisions if they were being paid for other services, if they would make bad decisions in the audit, which is basically what happened with Andersen. Speaking of Andersen, prior to 2002, the auditing profession was self-regulated, i.e. auditors reviewed the work of other auditors. What do you guys think about that? Auditors reviewing the work of other auditors. Let's put it in the classroom contest. Instead of me grading your materials, instead of me grading your exams, you can grade each other's exams. It'll be my first all A class ever. I was like, I got 100% again. How many questions you missed? I missed like 13, but they were all accidental. I knew what I was doing correctly. Yeah. We talked it over and we were pretty happy with it. Yeah, some problems there. Some problems with self-regulation, okay? So what happened then? Well, this thing happened, okay? And then this thing happened, and this, and this, and this. Oops, sorry, and this. So yeah, a whole bunch of big accounting scandals that just kind of a cascade effect. Like it was very interesting because I was a student at the time this was happening, and like over a year, it was just like another accounting scandal. It just got to the point you were just kind of like, okay, I don't even care anymore. It's just a daily thing happening. So then they passed this. Is everybody familiar with this? Hopefully you've heard of this, the Sarbanes-Oxley Act of 2002, or SOX, okay? By the way, if you wanted your own copy of the Sarbanes-Oxley Act, I put one on Brightspace for you because every accounting student should have a copy of SOX, okay? We'll actually refer to that when we start talking about some of the things in Chapter 3. One of the subsets of the Sarbanes-Oxley Act was to change the environment of auditing. Auditing was originally oversaw by the AICPA, or the Auditing Standards Board, specifically the Auditing Standards Board, the ASB. They still have oversight of private or non-issuer audits. They still do the work for that. But they created a new independent organization called the PCAOB, the Public Company Accounting Oversight Board. So the PCAOB they set separate standards. They're very similar standards, but they adopted some new standards to try to improve the quality of audits that were performed in the United States. Now, has been a good thing? It depends on who you ask, okay? This is a very interesting time to see what's going on with public company audits, because one of the things that's going on with the current presidential administration is the thought about whether the PCAOB should eliminate it and rolled into the SEC. This is actually the environment we had 23 years ago, and it did not go well in that scenario. So a lot of people are saying, yeah, don't do this. We'll go back to the Enron debacle or the WorldCom debacle, which if you're not familiar with any of those, look them up. Wikipedia, I don't have the time to go through them right now, unfortunately. All right. So what are some things that we need to be aware of for auditor perspective? Well, we need to exercise due professional care, which means that we have to exercise professional skepticism. We do not take everything at face value. We question everything, and we critically assess audit evidence. I know as students that you have the tendency to want to say whatever the instructor says is correct. I'm not going to try to fool you in this class, but I'm not going to also say that everything I say is 100% accurate. You need to get in the habit of exercising a mindset where you question everything, particularly in the audit mindset. Understand if that's correct. We want to actually have support for every assessment that we make. In addition to regulatory bodies, auditors are generally accountable to a governing body or organization, which is called corporate governance. Now, I want you to write these concepts down. So corporate governance, previously you referred to them as board of directors. These are the representatives of the shareholders that are elected or chosen to represent the shareholders. I don't think they're elected, but they're chosen to represent shareholders. So a subset of the group organization of shareholders that are oversee the organization. As auditors, we have a separate corporate governance mechanism in many cases. This is called the audit committee, which is a subset of the board. Now, if you've never heard about the audit committee, we're going to have some details on them on Friday. Suffice to say, there's some very specific rules under PCAOB guidelines that have to be followed. So our model for business processes, this is the end of the chapter, but I do want to reiterate that we're going to be talking about how audit works in real scenarios. Our first two exams are just going to be covering general audit knowledge about how they apply in a very general specific or general scenarios. These are going to be specific settings about how do we apply everything we've learned for those chapters in these settings. Some of these are going to seem familiar, should be familiar with the revenue process and the purchasing process. So we talk about those specifically in AIS. Similarly, inventory management. We're also going to talk about human resources and as well as financing process, which is going to contain 3 chapters, which is going to cover any different financing and investing mechanisms that we could actually have in place. All right, last thing to talk about. You notice I've been looking at my watch. I want to make sure I get this all in, but I want to go right to time, all right? So ethics is a really big, important thing in auditing that we have to know. It's a system of code of conduct that are based on moral duties and obligations that indicate how we should behave. This is closely related to the concept of professionalism, which refers to the conduct, aims, and qualities that characterize a profession or professional person. The AICPA takes a really big prideful stance in the fact that professionalism should contain ethics. So much so that for our occupation, we have a code of professional conduct that establishes our guidance for acceptable behavior for auditors. It contains principles, rules of conduct, and interpretations of the rules of conduct. A major portion of the code identifies actions that impair auditor independence. After the second exam, we're going to have a primer on the code of professional conduct, and about 10 minutes of it is going to be talking about the rules of conduct, which are very straightforward. It just basically says be a good person and a good accountant. And then we're going to have another 20 minutes where we're going to talk about all the rules of independence, which are a lot. Independence as an auditor is extremely important. Okay. And with that, we're done. Just in the nick of time. Please keep in mind that homework, your first homework assignment is due on Friday before class. We will be starting out with chapter 3, and we'll start with chapter 3, go about 30, 35 minutes, and then we'll talk about homework at the end of class on Friday. So I'll see you all then.